Okay, let's talk liquidity, right? And liquidity concepts. Let's get a set up and an understanding about what liquidity is, because it really helps us with our trading. I think probably liquidity is probably one of the most difficult concepts, just because it's so subjective. There's loads of reasons. I mean, look, what is liquidity? Liquidity is nothing more than the food for the market, right? You need buys, you need sells. If there's no buyers and there's no sellers, then there's no transactions, right? So whenever we talk about liquidity, we're just talking about transactions, right? Sometimes there's a lot of liquidity, sometimes there's not a lot of liquidity. And so when we come across illiquid markets or a lack of liquidity, it causes problems if someone wants to buy at a specific price. And so, you know, what you find specifically in our market and where we're at is we want to try to understand what are the traps and the manipulation that occurs within the market for liquidity purposes, right? And this is essentially what we're going to go over. As I say, it's very subjective. People will have differences of opinions when it comes to this stuff. This is just my understanding of liquidity. I think I have a good enough grasp in the sense that I have a sense where I think liquidity lies and how the markets try to move. So we're going to go over a little bit of an example. We're going to try to talk and theorize liquidity in a bit of a template that I've drawn up, and then we're going to cover some charts and try to find these different types of patterns and understand what they are, right? So let's just talk about why it's important first of all. So let's say we're talking about spot, not futures, but spot. Requires buyers and sellers, right? On spot BTC. And let's say a whale wants to buy 1,000 Bitcoin, right? Well, let's say for whatever reason, when he wants to buy them Bitcoin, or she, they want to buy a specific price, okay? And so when we look at a typical order book, like on this particular exchange, you can see what liquidity is available at all of these different price ranges, right? So, you know, 26,968, there's 9 Bitcoin, there's 10 Bitcoin above that. So all of these different price levels have an amount of resting liquidity, let's just say, that's sitting waiting to be filled. So this is what we talk about when we say liquidity, right? Now, let's say I want to buy 1,000 Bitcoin at 26,990 on the dot. Well, for me to buy that, there has to be 1,000 Bitcoin at that price range. And if there's not 1,000 Bitcoin, well, then what it will do is take the next price up, and then the next price above that, and the next amount of Bitcoin above that. So effectively what it does is it creates this slippage in the market where that purchase, that single purchase, will go and absorb all of the liquidity until it fills its 1,000 Bitcoin requirement. And so your initial buy order, what you thought was going to be, you know, somewhere around that 26,980, will actually average what the total amount of liquidity was across the entirety of the price range. And so your average buy price, what you thought was going to be 26,990, may actually be 27,045 or something like that, 27,045, which is a lot higher. And that's essentially what we call slippage within the market. It's where large orders come into the market, it completely wipes out the order book, meaning that, you know, when we see these big imbalances, I've talked about this in previous modules, but it's an overwhelming disproportion, right? It's where one side of the book becomes massively outweighed from the other, and so you get this huge big move which just completely absorbs all the liquidity across these lines. And so, you know, if I'm a big bank or a whale or some sort of institution, I have to think a bit cleverly about how I want to, you know, take them trades. And so what you'll often see is manipulation within the markets. It's this idea of trying to create pockets of liquidity where there's going to be a lot of kind of activity and a lot more liquidity at specific areas to kind of move them in. So we're going to go back into the chart and just kind of go over some of this. And so let's say for whatever reason, you know, the whale wants to buy at a specific price, we'll say, I don't know, 27k or whatever, right? And he knows at that point there's not enough liquidity to place that order without, you know, coming subject to slippage, right? And so what will happen is you'll see this, you know, when I'm talking 1,000 Bitcoin, it could be a lot more clear if someone's buying 1,000 Bitcoin. They're a whale, they're an institution, they are big banks, they are, you know, big players in the field, and they can afford to kind of, you know, move the markets. And so what you start to see is this kind of range thing building up, right? Which can stay in and consolidate for such a long time. And of course, what happens with this is we have above the range, you know, people are selling, When we come to the bottom of the range, people are buying, comes back up, people are selling, people are buying, people are selling, people are buying, and then people are selling. And then what you see is this stop losses and conditional longs. So stop losses are for the people who are sold, and just put on a tight stop loss there, high leverage, whatever it would be. If it was futures, of course, but on spot it would just be your normal stop loss. And then to the bottom side, to finish on that, the conditional orders, they are just waiting for the breakout, right? So waiting for that long to get triggered, expecting a breakout to the upside. So this is creating a lot of liquidity in these zones, right? And then of course we create a lot of liquidity to the downside as well. So within this range, what's happening is liquidity is being built above the range and below the range. And so we never know when the amount of liquidity that's satisfied for the move is going to be required, because we don't know, number one, how much a specific institute will want to buy, or how much a whale will want to buy, or multiple whales, or whatever it would be. We just know when you start to see these patterns that continuously hit certain angles, and to the trained eye you can see these forming. You always know, okay, a move's being built, whether it's kind of a flatline liquidity like this, or some sort of a pennant of some sorts, or a bull flag, a bear flag, whatever it be. And so you've got to kind of always be mindful of that fact. So then what tends to happen is, once enough liquidity is being built, we get the fake move, right? Big move to the downside, normally perpetuated by the whale. So it's what we call a sell to buy, right? So that move is a big move, which the whale will initially sell to smash all of this liquidity, drop the price as low as it can possibly be, then fulfilling his orders. Okay, so the liquidity from all of these longs, plus the push down and the conditional longs, may be enough to fulfill his liquidity. So then he puts his buy orders in, and it might not be the full 1,000 BTC in one go, it could be half of that. And then as prices come up to here, comes back down, generates these stop loss. So obviously you've got an equal low here, or a double low, or double bottom, call it what you want. But then liquidity keeps getting generated. So let's say those buys have occurred, price comes down, then we create more liquidity here, right? Because what is it? It's a break of structure, right? It's a 15-minute break to the high side, and then we come down here, and then what do we get? We get this kind of single move down, which doesn't do its job, right? So we come down here. I'm just going to put my draw tool on just so we can signify this. We get the stop here, price comes up, we build up liquidity here. Of course, we're building liquidity here. Whenever you get every single candle is effectively liquidity, right? So each time a candle stops, there's going to be stop losses, and there's going to be longs being triggered or shorts being triggered each time a candle is formed. And so effectively each time we come up and make a new move up and down here, we're just creating and generating more liquidity, right? So we have liquidity here, of course we're going to have liquidity there, and again here on this larger move, stop losses and conditional orders, because they're waiting for the breakout, right? Because we've already seen a move to the upside, it's come back down, move to the upside, and so they're expecting another breakout trade, right, to happen here. And so stop losses are generated and conditional longs are also generated there. But of course, instead, these stop losses that are generated here, we smash through. But just as an extra kind of problematic retail issue, is they just stop here and create that double bottom. And these are perfect patterns you see all the time at play, where you get that kind of point at which price just stops and reverses. And of course, what's that feel like when you're a trader and you're looking at that range? You're thinking solid, strong area, it's not going to break through. Really what we should be thinking is manipulation. This is building up additional stop losses and short conditional orders waiting for the breakup. Sorry, conditional shorts, that would be waiting for the breakdown for continuation of liquidity, right? Because remember, every single buy needs a counterparty sell, and every single sell needs a counterparty buy. So you have to have equilateral amount of liquidity each side in order for that break, or that, sorry, for that transaction to happen. And so of course, stop losses get created here, and conditional longs, and then we break to the upside, right? Break to the upside, clear an old high. So this high is being cleared out, broken all of the liquidity, claimed it all there, and now we start coming down. And of course, our friend here now, so who was in original drawdown from the initial short, As price starts coming down here, he can now get out of that move, having sold at the top, which is this move here, right? And this is just theoretical, of course, but our whale who purchased his 1,000 Bitcoin has got out at a nice tidy profit, and maybe started selling on the way down to claim his profit. By the time he comes down to here, that original sell here, he can now get out for maybe a break even, right? So he's made himself a nice tidy profit with the manipulation of moving the price each time. And that's essentially what happens. Of course, you've got your double bottom here, and again, eventually, you know, we come down to make a new low. Don't make the new low, in fact come up, claim the liquidity, and then smash back down. And then of course the classic pattern we see, you know, these diagonal channels. Okay, this is exactly the same as this here, but of course it's diagonal. And then what you normally get, the fake move to the upside to clear out all the liquidity that's been built above the top. And you'll often find, you know, where you've got liquidity, where the liquidity is being built here for stops, you tend to always find that the high point of the move to the upside as the fake break will always clear out the liquidity for the entirety of the channel before effectively continuing that move to the downside. And so liquidity comes in lots of different formats. It's just trying to spot and try to keeping your eye focused on effectively where these formations are occurring. And so go automatic, right? So what can we see? You can see here we have a nice classic, let me take that magnitude off. We've got that kind of channel there, and then we've got the channel here, creating that kind of nice triangle. And so, you know, move breaks down, and then effectively what you see is that initial fake move to the upside. So even though it takes a bit of time, we get one last push, price comes down, and then it clears the liquidity here, right? So that liquidity gets completely stamped out from all of that, but then all of that liquidity that's being built to the upside gets absolutely smashed to the downside, right? So that's just a classic kind of shape and pattern that you start to see, you know, bottom, top, and then bottom again before it breaks out. Break isn't significant at all because it hasn't taken that liquidity. In fact, what it does is it breaks to the upside here, takes the liquidity here, takes the liquidity here, which is that old bottom, if you remember, the old top. And so we've taken the liquidity here, taken the liquidity from this pennant, I call it a kind of a upward pennant or an upward triangle, call it what you want, but that's the kind of patterns that you tend to see. And then of course liquidity gets taken here, fake move to the upside. So realistically that could be the buyers, the whales, pushing price up, knowing that they wanted to get a sell order in, and of course bang, you get that sell order comes in, sell order comes all the way back down. The buyer, the seller, the whale or the whales, the institutions that have created all of this liquidity here in these moves, has now perpetuated the move down, probably with the huge move there you can see. And then of course what does price come back and do? Right the way back up so our friends can get out at break even again, right? And that's the kind of concept you see time and time again, is this understanding of, I guess, building patterns for liquidity, right? I'm just going to zoom in a little bit so you can see the candles a little bit better, right? So what else can we spot? Not quite a double top here, but you can see, not quite, but you know, enough for that kind of feeling that this is going to be a zone that might not break, and if it comes back up here, you know, price might start to come back into that zone and break it. So then you've got a similar thing here. You have a nice channel there, but of course fake move, breaks down, clears. So it's like, think about this, right? We keep bouncing off this channel, bounce, 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 and then you're thinking it's going to break. So what did I say before, right? So this is that kind of idea where you've got all of your sells, your stop losses and conditional short orders ready here. But of course what happens, everyone's waiting for the break, right? Because it's an upward pennant. So normally when you see the flag that's rising, you expect the breakdown. Of course we get the breakdown, but it's a fake break, right? Claims the liquidity, push to the upside, wrecks everyone who got short, and then price has moved to the upside. Okay, So just kind of keeping your eyes trained and focused on those things. You can also see as well, actually, that same pennant is probably just about there. It's not the cleanest. But anyway, you get me picture. That's the kind of channel that's been building, you know, over a couple of days or whatever it be. And then you get the break, followed by the move to the upside. What else can we see? Let's keep going. Let's get rid of that. See a nice, beautiful double bottom here, right? You know, so to the untrained eye, that's a fantastic level, right? Really strong level. That's never going to break. Okay, so you get your first hit. Yeah, so once we make this hit, of course, everyone's euphoric because they're thinking, I've got that bottom. It's perfect. And look, we just to add insult to injury, you know, we don't quite make that top, but that's, you know, that's that double bottom that everyone likes to see. What happens? Pushes away, and then we smash right the way through it, right? So we break through the double bottom. So if you've longed here and you've not taken profit here, guess what? You're probably going to be liquidated, right? If you wasn't savvy and you didn't put stop losses in play. And that's what we see time and time again with liquidity. It's just all about generating kind of these patterns that give you the sense of, because we're all humans, right? When we look at patterns, we think, you know, and by the way, I should say, depending on what type of trader you are, patterns can sometimes go in your favor, because if you're early enough on the patterns whilst liquidity is being generated, there's absolutely nothing wrong with getting involved in a trade and trading the range, right? I think, however, the better move is waiting for the break of the double bottom or whatever the channel is, because you always tend to find you get that initial breakdown and then the reversal. It doesn't happen all the time. Like here it didn't. You can clearly see, you know, that's again, like imagine you get a little small wick there as a small liquidity grab, thinking price is going to go in, and you ape in again, and followed by that complete, you know, jump down. So, but if you look, this is just like one big liquidity gathering range. So if you remember when I drew the pattern that looked like that, but it's just gathering liquidity, what we don't know is which way it's going to break, right? We're never going to know that. Of course, we get a couple of moves down, but we trade in this range, which is just consolidation, just liquidity gathering, waiting for that move to happen. Of course, the move happens, we come back up. So everyone who's dived in here straight away, again, if you're not taking profits, of course, price comes back in to what we probably see as a bit of a demand zone here, or a supply zone. What's next? What else do we see? You can see it here again, right? So you see that kind of, well, actually I'll do that as a channel. We can go from here to here. You can create that channel there, right? So you can see again, we are trading within a channeled range. Of course, eventually the range breaks, right? And it breaks down. Now, is that the fake move? Absolutely it's the fake move, right? Because what happens? Everyone gets super bearish, thinking the channel's broke, only for us to turn bullish and bring it back into the range, right? So again, think about it logically. Liquidity is being built, okay? And now higher players, bigger players in the field, they have built enough liquidity. They've created the stops all down here. They've created the conditional sell orders, expecting the traders to jump on the shorts. Of course, they start the move with the short, bang, rip it out. And then, of course, what happens then is they place their larger orders, right? Or they start to induce their larger orders. And you can see here, by the way, these vector candles, bang, 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 bang. All of these vector candles are really just those bigger buys coming into the field, right? Where the liquidity is being generated. They've initiated the move to the downside, because what they're looking to do is obviously go into drawdown, because obviously they're not planning on a short, they're planning on a long, but they've used this as to gather liquidity, created that kind of narrative or bias that a breakout's going to occur. And if you're savvy enough, you can actually win on these. You can still, you know, get the chance on a breakdown, but just bear in mind, more times than not, you tend to see when these breakdowns occur, they occur with the opposite bias in mind. And so, you know, you don't tend to see lower low and then another low and then another low and another low after the move to the upside. It's what I've seen in my back testing and my experience is it tends to just be an initiation move to push price back to the upside. So we see it again, Price obviously pushes up. It really rips up at that point once that's being consolidated. Okay, so what else can we find? Any more good examples? I mean, this is a, what time frame are we on here? 30 odd. Okay, let me just look at this. Okay, you've got a channel there, haven't we? Nice little channel. Yeah, rejoin, connect the highs, draw to the lows. Perfect channel range. Of course, we're expecting the break to the upside, which we get. But then what happens then? Whale gets his, when he actually wants to sell, he sells down there, bang. So he perpetuates the initiation of the move to buys. You can see by the vector candles, price comes back into the range, buys comes back in again because there's a demand zone here. Buys come back in, and eventually that sell-off occurs. Buyer gets out, main whale gets out at break even, while selling at the top for his move. So you see this all the time. Liquidity is, as I say, it's the food for the market, but having an understanding of liquidity, about how we operate with it and how we incorporate that as part of our kind of market structure awareness, understands about kind of supply and demand, which we'll cover in the next session. We start to put all of these things together. It just makes you a more cautious and kind of savvy trader, that knowing when you see these patterns and formations and shapes start to build, that you've got a good sense on what's going to happen. Whilst you're never going to know which way the move goes, what you do know is eventually when that move breaks, there's a highly likelihood that that's just the initiation move that's going to reverse it at some point. So it's just having that in your mind alone is a really good piece of knowledge. Okay, what else can we find? Perfect classic kind of move. So price is being moving up, we create a top here. So then what happens then? Typical market structure. So create a high. Okay, let me just draw that out really quickly. We have a high point. I'm going to do this quite rough, right? So 15-minute high, 15-minute high. So what we know of that is that's just creating nice momentum to the upside, right? High, nice bullish market structure. And then this would be our high term time frame top. So this might be, as an example, the 4-hour high, right? So then what happens? Price starts coming down, and then we get our bearish structure very quickly. This will make sense in a second. 15-minute trend change, so on and so forth. Another 15-minute there, another 15-minute there, another 15-minute there. However, of course, this is that, even though we're going bearish, price decides it needs one more clear out of old highs, which is here. From that, maybe that's a 4-hour top if we were to bring that to the 4-hour zone. But instead of flipping bullish, what does it do? It takes out liquidity, does nothing more. How do we know that that was nothing more than a liquidity grab? Because it breaks the low, right, and creates a 15-minute trend change to the downside. So that's probably let's say it's a 4-hour TC to the upside. But you understand what I'm saying? So we've gone 15-minute up, 15-minute up, created a top, a local top, started coming back down. The continuation of the trend is still down, but it decides to do that one quick smash and grab to grab liquidity. Who's that? Well, that's obviously going to be big players and whales who want to make that move to the upside just to claim that liquidity there. Then perpetuate that sell, right? So obviously they're going to go into drawdown. I don't know if price comes back up, or yeah, there you go, right? Okay, so obviously when price comes down here, we continue lower, but Mr. Whale, who's got his sell order in here, took his profit here, but obviously from the buy that he initiated from down here to get to the up here, because this is where he wanted to sell from, right? For whatever reason he wanted that price, he's had to wait and draw down to here, and that's all about liquidity. It could be one player, could be multiple players, doesn't really matter. It's just to move the price of Bitcoin, like from here 30,181 to 31,500 over what is that, quite a substantial move, let's just say. It takes a lot of effort, right? A lot of smashing through that order book that we went through before. And so this is just, if we're making continuous market structure, higher highs, higher lows, this is just a liquidity grab, right? Because why didn't the pullback just come in to say here and then continue up for legitimate market structure? Instead, what it did do is up, down, up, and then continued down, creating that lower low. And so there you've got it. It's liquidity, right? It's all to do with, back to what I spoke about at the beginning, which is this order book, getting the best amount of value for the order that you want. And so what they do, you know, hedge funds, big players, big institutions, they want to get the best price for their clients and try to get the best deals. You know, get me X amount of Bitcoin at X price. Okay, what do we have to do that? Sorry, just let my cat out. Sorry. So that's it. That's liquidity in a nutshell. You know, it doesn't have to be complex. It is complex when you see it in the chart and the candle format. It's no different from what we've just seen there, just in different formats. You know, that kind of initiation to buy, create the liquidity, drop the price down, push the price back up, sell when he's at his happy medium, and then get back out at delta neutral. So that's liquidity, guys. Incorporate it into the trading stance, understand it, try to, figure out, try to spot where these liquidity points are lying. Very, very, very important and powerful stuff to get into. Next, we're going to talk about supply and demand, and this will kind of bring everything together. So thanks very much for listening, and I'll speak to you soon.